I've got 5 easy steps for you that are the roadmap to getting an 800 credit score and saving tens of thousands of dollars in interest. Let's get started. All right, so some of what I'm about to cover you may have heard before, but I really want to focus on making this as simple as possible because the topic of building your credit score is oftentimes unnecessarily complex. But I promise you, it's really not that hard, starting with step number 1, which is always making your on-time payments. And not only is this step number 1, but this should be priority number 1 no matter what. And that's because your on-time payment history makes up 35% of your credit score, and one missed on-time payment will stay with you for 7 years on your credit report. Now, whether we're talking about your small credit card balance or your larger student loan payments, in order to be considered an on-time payment, you must be making at least the minimum payment due. Now, my suggestion is to always pay off all of your balances in full on time without fail. But I realize that if you have some credit card debt here, a mortgage payment, a car loan, a student loan balance, and everything in between, then obviously that's easier said than done. But no matter what your situation is, you really want to try to make at least those minimum payments. And another important thing to note is that a payment is usually not considered late unless it is 30 days past due. So if you forget to make the payment on your credit card one month, then no stress, the credit card provider is usually not going to report that to the credit bureau until you are 30 days past the due date. And while you usually will incur some kind of late fee, you may be able to call up your card provider or lender, explain the situation, especially if it was an honest mistake, and hopefully get a late fee waived in some situations. It's literally a 5-minute phone call, and the worst they can say is no. But the easiest way to avoid all of this headache is just to set up autopay. Most major card providers and lenders for that matter will offer some form of autopay, which you can set up to pay the minimum balance, a specific amount, or the entire statement balance, which again is what I personally recommend if you can. And some lenders will even offer lower interest rates if you have autopay set up with them, so this one is kind of a no-brainer. Lastly, when it comes to on-time payments, most payments are due on a monthly basis, which means each line of credit gives you 12 opportunities per year to make an on-time payment. And the more on-time payments you have, the smaller impact one missed payment will have on your credit score. For example, if you only have one credit card and you've made 4 on-time payments, but you missed the 5th payment, then that means that you've missed 20% of your payment dates. Whereas if you have a good credit mix, which we'll talk about more in depth, then multiple on-time payments across multiple lines of credit means that missing one payment isn't as big of a deal. But avoiding all of that is really not that difficult, so just set up autopay and enjoy perfect payment history. All right, so that first step alone is definitely gonna set you on the right path, but the second step makes up an additional 30% of your credit score, and that would be your credit utilization. And in this case, we wanna keep your utilization as low as possible. This is sometimes where people get a little bit confused, so let's break it down to make it as simple as possible. Your utilization is simply your total balances across all of your lines of credit divided by the total credit that is available to you. So for example, let's say you have 2 credit cards and one of them has a balance of $500 and the other has a balance of $200. And for the sake of simplicity, let's say that each of these cards has a credit limit of $1,000 each, meaning that the most amount of money I could spend in a month with both of them is $2,000. So that means that the total balance is $700 divided by our total available credit, which is $2,000 like we just said. And that means that in this example, our credit utilization is 35%. Credit utilization below 30% is typically considered good, but we're shooting for an 800 credit score, so we need to be way better than good. I usually try to keep my utilization below 5%, which is achieved using a little-known credit loophole. But before we get to that, you're probably already getting a little bit overwhelmed and confused, but don't worry, there's actually some fantastic products out there that can help you keep track of all of these different credit variables and keep an eye on your credit score. And that's where today's video sponsor, Aura can help you. I've talked about Aura many times before, and this is truly the easiest way that I have found to track my credit score and protect financial information, which unfortunately does get stolen. But usually it's not until you can't log into an account or find fake accounts in your name that the panic and fear starts to set in. And at that point, you're going to wish that you had Aura. Aura is credit monitoring, identity theft protection, a VPN, password management, and antivirus software all bundled into one easy-to-use app on your smartphone. It's going to monitor the dark web for emails, passwords, social security numbers, and send fast fraud alerts right to your smartphone in real time. You'll also get a notification anytime a new account is added to your credit reports, and I can say as someone who has an insane amount of financial accounts that Aura really does give me immense peace of mind. Plus, I'm even able to set up transaction limits on each of my cards, so if any transaction is over the limit I set, I immediately get a notification on my phone. So as you embark on this credit building journey, don't wait until it is too late. Check out our sponsor Aura using the link down below in the description to get a 14-day free trial and protect your financial accounts from fraud today. All right, so the little known credit loophole that I use to lower my utilization is actually paying off certain balances before my card statement is processed each month. Remember that your credit card statement is just a snapshot of time, and anything else that happens throughout the month around that date is honestly irrelevant if it doesn't show up on your card statement. For example, let's say you have one credit card and that has a $10,000 limit, but you make a large purchase of $8,000 on that card. Well, if you don't pay down that balance before the statement is processed, then the utilization would be 80%, which is obviously horrible for your credit score. So instead, what you could do is pay down a majority of that $8,000 balance before the statement is processed, still reap the benefits of putting that large purchase on your credit card while also keeping your utilization really low. But don't get hung up on this utilization stuff too much because it can definitely make your head spin. And there's of course gray areas like charge cards, for example, which technically don't have a hard credit limit and therefore don't really contribute to your utilization. If you have large balances on your card, then try to pay them down before your statement is processed, and overall try to use less than 10% of your total available credits, and you will be just fine and keep your utilization nice and low. But the other much easier way to instantly improve your utilization is by increasing your credit limit. Remember that equation I showed you earlier where the balance is on top and the total available credit is on the bottom? Well, by increasing the denominator, which in this case is the total available credits, that will decrease your utilization, and usually you can get a credit limit increase by calling the number on the back of your card, or in some cases just fill out a simple form online and get an instant increase on your credit limit. So I would definitely give that a shot before you go doing credit card gymnastics with your balances. All right, so honestly, those first two steps make up 65% of your credit score, so needless to say, they are by far the most important. But there are a lot of other variables that you still need to be aware of, and don't worry, these ones are much more passive, but they will require a little bit of patience on your part. I say that because the third step is improving the age of your credit, which makes up 15% of your credit score, and obviously the only real way to improve the average age of your credit is to just wait things out and let your current lines of credit get older. So if you have not yet opened a basic beginner credit card, then definitely go ahead and do that immediately, because the sooner you get started, the sooner you'll be able to have those older lines of credit on your credit report. I, for example, am only 23 years old, but I opened my first Discover It credit card on my 18th birthday, which means that despite my young age, I have lines of credit that are over 5 years old on my accounts, and I'm rapidly approaching that 800 credit score because of that alone. But my biggest tip with this one is if you're opening your very first credit card, make sure that it is a simple, no annual fee card, because really, no matter what, you'll want to leave that account open for pretty much forever. Closing your oldest line of credit would obviously have a huge negative impact on your credit score, so get something like the Discover It credit card, and even if you eventually get more premium products and you're not using those older cards anymore, just leave them open. They aren't doing any harm, and if anything, they are really helping improve your credit age and therefore your credit score. Obviously, with step 3, you really just have to be patient. So be strategic about the accounts you open, and then really just focus on steps 1 and 2. Speaking of which, that brings us to step 4, which is carefully timing your new credit. This is where things start to get very minute, but your new credit does make up 10% of your score on its own. And the reason I say the timing of this is very important is every time you apply for any line of credit, you'll likely see what's called a hard inquiry show up on your credit report. And that usually stays there for up to 2 years. And each hard inquiry is going to have a temporary negative effect on your credit score. So if you're thinking about applying for a car loan or a mortgage in the next few years, then I would try to avoid any kind of hard inquiry as much as possible, because when the mortgage lender pulls your credit report, for example, you want your credit history and credit score to be as pristine as possible, because even a slightly higher interest rate on a several $100,000 loan could end up costing you tens of thousands of dollars. Not trying to scare you, and again, the first 2 steps are much more important to focus on, but just be aware of this and think carefully anytime you are about to apply for a new line of credit, because that hard inquiry is going to stick with you for 2 years. All right, the 5th and final step is simply being aware of other variables, but don't stress about them too much. This would be things like your credit mix, meaning do you have just credit cards, or do you also have a mortgage, an auto loan, student loans, and other types of credit? Technically, a better credit mix is going to be good for your credit score, but from my perspective, taking out a car loan or slowly paying off your student loans just to improve your credit mix is a horrible idea, and the interest rate that you will pay on those balances will far outweigh any possible benefit that you will see from slightly improving your credit mix. I, for example, only have my credit cards and my mortgage, and otherwise I have never had any other line of credit in my name, and I was still able to build a fantastic credit score at a really young age. So again, I say don't stress too much about these other variables, but definitely be aware of them. Lastly, you might want to be aware of your rent and utility payments if that applies to you, because while they usually don't have any impact on your credit score, if you or your landlord is using some kind of rent reporting service, then yes, that can be a fantastic way to safely and easily build your credit score. But that also means that a late rent or utility payment could mean a late payment on your credit reports, which, as we talked about earlier, you want to avoid at all cost. So I know that was a lot of information at once, but honestly, if you can pay off all of your lines of credit on time and keep your utilization as low as possible, then you will really have no problem building a credit score in the mid to high 700s in a relatively short period of time, and you will be well on your way to an 800 or better score. Be sure to check out today's video sponsor, Aura, using the link down below the like button to help keep track of all of these different variables, and check out this video to see what cards I carry with me every single day. Take it easy, and I'll see you in the next one.